Hello everybody, welcome to my video Crisis Risk on the Rise, Gold as Insurance. Inflation is rising worldwide, causing great and increasing economic pain for many people. In an effort to curb the excessive rise in goods prices, many central banks have already started raising interest rates. While tightening monetary policy is undoubtedly necessary, it comes with a certain risk. This becomes evident when we take a closer look at the underlying forces pushing goods prices higher. On the one hand, there is a negative price shock resulting from the politically dictated lockdown crisis and green policies. It has reduced the supply of goods relative to demand, and it has driven up energy and thus production costs. The war in Ukraine exacerbates these effects. Taken together, the price level in the economies is being pushed up so that people's real incomes and thus their standards of living are falling. On the other hand, there is an enormous monetary overhang. Central banks have significantly increased the quantity of money in recent years. When the monetary overhang meets the negative price shock, inflation, that is, the ongoing rise in goods prices across the board, is the inevitable result. People do not only experience a one-off drop in their real incomes, but a prolonged and even more severe decline in their material wealth. This is a rather unpredictable environment for monetary policy tightening. Neither the negative price shock nor the existing monetary overhang can be reversed by the central banks raising interest rates. The negative price shock will sooner or later peter out, presumably keeping the prices of many goods at elevated levels. However, it will not lead to inflation, that is a permanent ongoing increase in the prices of goods and services across the board. The monetary overhang in turn is reduced by rising goods prices, that is a surge in inflation and/or higher output growth. All central bank policy can do at this stage is raise interest rates to a level that reduces credit and money supply growth, thereby hopefully lowering future inflation. In other words, there is unfortunately no quick fix to the inflation problem unfolding before our eyes. It is important to note that the negative price shock is restrictive. It lowers people's purchasing power and weakens the demand side of the economies. The creation of the monetary overhang in early 2020 was expansionary as the money stock in the economy rose while goods prices remained fairly stable. However, this has changed with inflation. Inflation now reduces the monetary overhang, devaluing the purchasing power of people's money holdings. Against this backdrop, it becomes clear that a restrictive effect is currently working itself through the economic system. In other words, a slowdown in economic activity is already underway. It could all too easily turn into a recession if monetary policy tightens too much. Therefore, the pressing question is, how high could interest rates go without sending the economies over the cliff while curbing future inflation? The disturbing answer is we do not know, and central bank council members and their staff would not know either. The truth is that central banks follow a path of trial and error. Needless to say, things can potentially go terribly wrong along the way. If central banks hike interest rates too high, as they set rates in view of current inflation, for example, a recessionary scenario becomes quite likely. And if they keep interest rates too low, inflation will be high, even much higher, longer. Most important, monetary policymakers probably know that the scope for interest rate hikes is quite limited given the extremely high level of debt in the global financial system. In many countries, real interest rates, that is nominal interest rates adjusted for inflation, have been in negative territory for the past decade. Bringing them back above zero is virtually impossible without dealing the economic and financial system a rather hard, perhaps even fatal blow. Imagine a scenario in which central banks inadvertently cause a recession and collapse financial markets. I would think that monetary policy would change course immediately, quickly reverting to an extremely inflationary stance. After all, the financial and economic stress would likely be extremely painful, and sustained high inflation would soon be considered the lesser evil compared to shrinking output, large-scale credit defaults, and mass unemployment. All in all, there is a risk of crisis for the investor that should not be neglected. It comes with a profile that is, and most likely will remain, heavily skewed to high inflation in the years to come. Real interest rates, particularly for short-term and high-quality bonds, should remain negative, and even if central banks further tighten policy. In view of the incipient weakening of the global economy, this seems all the more likely as it further limits the scope for higher interest rates. Holding physical gold and silver is and remains an effective strategy to reduce investment portfolio risk, namely the risk resulting from a permanent debasement of the official currency's purchasing power, and the default risk that would result from a hard landing in the current cycle, let alone from a collapsing financial and economic system. At current prices, physical gold and silver can be viewed as effective insurance with considerable upside price potential. I would like to conclude with a quote from Alan Greenspan, the former Federal Reserve Chairman. In 2014, he wrote, quote, "Gold has special properties that no other currency, with the possible exception of silver, can claim. For more than 2 millennia, gold has had virtually unquestioned acceptance as payment. It has never required a credit guarantee of a third party. No questions are raised when gold or direct claims to gold are offered in payment of an obligation," quote ends. In times of rising crisis risk, I think it is rather helpful to remind ourselves that today's official currencies or fiat currencies suffer from irreversible economic problems, and that physical gold and silver would probably rank among the very few monies that could protect investors from the global fiat money system going down the drain. In other words, there is certainly a case for holding at least some physical gold and silver in the current cycle. Thank you very much for your attention. If you enjoyed this video, please like, share, ring the bell, and most important, follow and recommend my channel.